All right, welcome to Talk Tickers. Today, we are digging into The Honest Company. Their Q3 results just dropped, and wow, the market's reaction was, well, let's just say it was brutal.
So let's just get right to it. The headline number you have to see: the stock absolutely cratered, down almost 30% the very next day. I mean, that's not just a dip, that's a statement from Wall Street about how they felt about this call.
And here's the crazy part, the paradox at the center of all this. On one hand, they actually beat their profit targets. That's good, right? But on the other, they missed on revenue. And right now, the market cares way more about growth. So that top-line miss just completely wiped out any of the good news. The punishment was swift, and it was severe. So you gotta ask, what is going on here? How can you beat on profits but get hammered like that? Well, that's exactly what we're gonna unpack. We're gonna look at what the management team is trying to do, why the market hated it so much, and then we'll give you our thoughts on where this all goes from here. Let's get into it.
Okay, first up, let's just lay out the raw numbers from the quarter.
Okay, so take a look here. The GAAP EPS, that's earnings per share, it came in at a positive penny. Now, the street was expecting a 1 cent loss, so that's a beat. That's the good part of the story. But, and this is a big but, look at the revenue, 92.6 million. They were supposed to hit almost 100 million, so that's a miss of nearly 7 million bucks, and it's down almost 7% from last year. That is the number that sent investors running for the hills. Now, facing numbers like that, management knew they couldn't just read off the results. They came to the call with a big announcement, a whole new game plan. The CEO, Carla Vernon, she gets on the call and calls it Transformation 2.0. Kind of sounds impressive, right? The whole idea is to pivot the company, get rid of the stuff that's not working, and double down on what actually makes money. And let's be super clear about what this means. They are intentionally making the company smaller. Yeah, you heard that right. They're choosing to shrink, to cut off entire business lines that just aren't performing, all in the name of becoming more focused and, hopefully, more profitable. And this is what really blew my mind. We're not talking about a little spring cleaning here. Look at this. The businesses they're getting rid of, they accounted for 22% of revenue just last quarter. That's a huge chunk of the company they're just walking away from. It's a massive bet. So what are they actually cutting? Well, for starters, their own website, honest.com, you won't be able to buy directly from them anymore. Then there's their clothing line, that's gone. And finally, they're pulling out of direct sales to retailers in Canada. 3 big moves. And they are not messing around. The timeline here is super aggressive. They want all of this done, dusted, and wrapped up by the end of this year. That is incredibly fast. Okay, so management comes out with this bold, maybe even painful new plan. You'd think the market might at least listen, right? Nope. They hated it. The story completely fell flat, and the market rejected it just completely. So why the hate? Well, investors basically ignored the long-term vision and focused on 2 things. First, the immediate pain of shrinking revenue. And second, the massive uncertainty. I mean, can they even pull this off? There is so much risk in a move this big. And this slide, this just perfectly captures the 2 competing stories. Management is saying, hey, don't look at the whole picture. Just look at the good parts we're keeping. That's growing 4 to 6%. But the market, Wall Street, they're looking at the total number, and that number is negative. They're guiding to a revenue decline for the full year. And in the end, investors vote with their wallets on the big, ugly reported number, not the nice, neat, organic one. And you know this was serious because it wasn't just a few people selling. Look at the volume, nearly 22 million shares traded hands. That's almost 4 times the normal daily volume? That tells you it was a full-on stampede for the exits. This was a high-conviction sell. So that's the story so far. It's a bit of a mess. The big question is, where do they go from here? Here's our take on what you should be watching. You know, the road ahead is just full of landmines. Think about it. They have to unwind all these complex businesses without messing up their relationships with big retailers like Target and Walmart. At the same time, they need to somehow magically accelerate growth in the parts they're keeping. It's really like trying to rebuild an airplane engine while you're still flying at 30,000 feet. So much can go wrong. So, what are we predicting for the next earnings call? Well, the top-line revenue number is probably going to look ugly again as they finish these exits. So you got to look past that. The 2 things to watch are, 1, the gross margins. Are they stabilizing or getting better? And 2, The big one, their first real guidance for 2026. That's going to be our first clean look at what this new, smaller, honest company is supposed to look like. So, for the stock price itself, yeah, expect a bumpy ride. The market is basically in prove-it mode now. They're not going to give management the benefit of the doubt. They need to see cold, hard proof that this shrink-to-grow plan is actually working. Until then, the stock is likely going to be stuck in the mud. So that brings us to our official rating. We're calling this an underperformer. Look, the risk of them messing this up is just too high. And in the short term, that shrinking revenue is a huge anchor that's just going to drag down any good news about future profits. And so that leaves us with the big final question, right? After taking a hatchet to 22% of their own company, can the honest company actually pull off this shrink to grow strategy? Or is this just the beginning of them becoming a permanently smaller, less relevant player? That's what we'll be watching.
And just as a reminder, this is not financial advice.